Now speaking, Anant Krishnan, Vice President, Corporate Development and Strategy, Aurora issued a news release announcing their third quarter and year-end financial results. Certain matters discussed on the call may constitute forward-looking statements subject to risks and uncertainties related to Aurora's future performance. Actual results could differ from those anticipated in these forward-looking statements. Risk factors can be found in their annual information form and other periodic filings as well as on SEDAR and EDGAR. Following prepared remarks by CEO Miguel Martin and CFO Glenn Ibbott, there will be a question-and-answer session with covering analysts. Participants are asked to limit themselves to one question and then get back in queue for follow-up. Now speaking, Miguel Martin, Chief Executive Officer. Aurora is pleased with their strategic and financial progress, having generated positive adjusted EBITDA for 2 consecutive quarters. They have achieved cost savings of $400 million over the last 3 fiscal years and are now announcing an additional annualized savings of $40 million by the end of fiscal 2024. Aurora remains the #1 Canadian LP and is well positioned to succeed in the global medical market due to its expertise in managing regulatory frameworks, commitment to science and genetics, and its strong balance sheet. In Q3, they increased their high-margin medical cannabis revenue and diversified their presence for resilience. They recently introduced 2 high-THC cultivars in Germany and are looking forward to possible descheduling of cannabis. In Canada, they have focused on insured patient groups, increasing their net revenues by $4.1 million from Q3 of the prior year. They launched a new program for Canadian patients and leveraged their science-driven cultivation advantages. Their Bevo business has seen significant increase in plant propagation revenue and they have completed repurposing the 800,000 square foot Aurora Sky facility for orchid and vegetable propagation. Their next goal is to maintain a net cash position and generate positive free cash flow. Now speaking, Glenn Ibbott, Chief Financial Officer. Aurora reported total net revenue of $64 million in Q3, up 4% from the previous quarter and 27% from the year-ago period. Aurora's strong balance sheet is bolstered by approximately $230 million in cash and cash equivalents, more than enough to fund operations until they reach positive free cash flow, projected to be achieved by the end of calendar year 2024. Management plans to capture an additional $40 million in annualized cash flow savings this fiscal year through closure of production at their facility in Denmark, targeted reduction of external SG&A costs, and other initiatives and investments. Quarterly operating cash use for planning purposes is estimated at around $13 million per quarter, with a goal of getting to low single-digit quarterly cash use by the end of this fiscal year. This does not include expected revenue growth. Additionally, interest costs will be reduced by approximately $2 million a quarter as remaining convertible debt is paid off by the end of the fiscal year. Capital expenditures are expected to average $2 million a quarter in fiscal 2024. Revenue from Canadian medical was $24.2 million, down 6% from Q2 due to timing of shipments. International medical revenue was steady at $13.8 million with continuing growth in export business to Australia. Medical cannabis represented 71% of cannabis revenue and 86% of adjusted cannabis gross profit. Medical adjusted gross margin was 60%, down slightly from last quarter but still within target range. Consumer cannabis net revenue was steady at $14.5 million and adjusted gross margin increased to 25%. Plant propagation net revenue was $10.8 million, up from $6.6 million in Q2, with adjusted gross margin of 36%. Adjusted SG&A was $28.4 million and adjusted R&D was just below $2 million, reflecting cost containment efforts. Fiscal Q1 2024 is expected to be similar to Q3 2023, with a slightly higher proportion of international medical revenue. Plant propagation is expected to have a seasonally strong quarter as peak selling period approaches. Adjusted gross margins and SG&A are both expected to remain consistent with Q3 2023. Now speaking, Miguel Martin, Chief Executive Officer. The Aurora Cannabis Incorporated leadership team recently announced that they plan to reduce costs by $40 million in order to reach their goal of becoming free cash flow positive by the end of calendar 2024. They have already achieved sustainable positive adjusted EBITDA, and they believe that their accomplishments to date will set them apart from their competitors in the global cannabis industry. The company plans to focus on growing and profitability in their high-margin medical business, as well as continuing to pull all levers at their disposal to create equity value for shareholders. This includes organic growth, strategic M&A, and continuing to focus on all the details that build a world-class company. Piper Sandler analyst Michael Lavery inquired, "What is your strategy for capital allocation and portfolio evolution given the current cash balance? Are there adjacency acquisitions you are considering to diversify your portfolio?" Miguel Martin replied, "We continue to focus on those areas in cannabis business where we can generate a return, and that is predominantly in the medical sector of Canada and Western Europe. Our investments in these areas are proving lucrative, with margins up to double what we see in recreational use. The regulatory landscape in Europe is also becoming more standardized, with EU GMP product being imported from facilities such as ours in Canada. We are expanding our presence in Switzerland and Austria, and our strength in Germany, Poland and Czech Republic will be integral to this growth. We have also seen advancements in genetics work at our facility on Vancouver Island, allowing us to provide high-quality, high-potency products with great yields for both medical and recreational use. Through acquisitions like Bevo, we have been able to leverage world-class facilities and gain greater consistency and value. As for the balance sheet and debt, it is our goal to pay off all convertible debt before their maturity next year, thus reducing our interest payments significantly. We are one of the few companies in a net cash position, and while remaining patient, we'll consider any opportunities that arise during this time of consolidation. ACB Capital Markets analyst Frederico Gomez inquired, could you provide some insight into the consumer cannabis segment, specifically regarding gains in market share and potential for future growth, particularly with edibles? Miguel Martin replied, thank you, Fred, for your question. We acquired Thrive a year ago to take advantage of their great portfolio and team adept at navigating the rec market. Despite price compression and value flower pricing, there are still places to make money, like concentrates, pre-rolls and injectables. Our share of the rec market is less than 3%, so we are being thoughtful in our approach and taking advantage of opportunities with our low cost of production and innovation. Provincial entities like the OCS have put in pricing floors, and we hope that will lead to more profit opportunities in the future. Our genetics, science and innovation from our medical channel can easily cross over into rec, so we are ready to capitalize when the opportunity arises. Zuanik and Associates analyst Pablo Zuanik inquired, Miguel, is it true that the German market is mostly driven by online pharmacy growth, and how can LPs compete with the variety of SKUs offered by these pharmacies? Miguel Martin replied, thanks for the question, Pablo. We're seeing growth in Germany's prescriber base, even though cannabis is classified as a narcotic, which is making it difficult for traditional physicians to prescribe it. Currently, cannabis usage rate is 0.1% of the adult population, and the German government is taking steps to reduce bureaucracy and open up the medical cannabis business. However, product quality and availability that meets the strict testing requirements set by the government is one of the key competitive drivers. In addition to this, there is also an increased demand for higher potency medications. We've introduced 2 proven Canadian cultivars into Germany, and the early response has been encouraging. Furthermore, with the rec solution being pushed back, consolidation amongst large players is expected. This will lead to improved efficiencies and allow them to consistently connect with patients across both online and brick-and-mortar platforms. Lastly, we anticipate that traditional pharmacies will be more widely used as regulations evolve. Cohen & Company analyst Robin Holby inquired, given the pivot away from the Nordic facility, what near-term gross margin headwinds should we expect, and how do you plan to increase gross margins above the 60% target? Miguel Martin replied, thanks for the question. The challenge with that facility was threefold: regulations on traditional remediation, size of the greenhouse and no difference in shipping to the European market. We started in the European markets with Canadian flower, which is seen as higher quality and provides a margin increase. We don't see any added costs in terms of the margin profile, and we expect greater efficiency in production, distribution, and sales/marketing to result in an accretive margin situation. BMO Capital Markets analyst Tammy Chen inquired, at this point, what are the biggest cost components in your quarterly adjusted SG&A of $30 million? What efforts have you taken to reduce costs going forward? Miguel Martin replied, Tammy, I appreciate the question. We've taken out $400 million in cost over the past 3 years and have announced an additional $40 million. The $30 million that you mentioned in SG&A is related to the complexity and cost of the cannabis system. We are confident that we will hit our goal of reducing costs by $40 million, and we will continue to look for opportunities to further reduce cost. As far as rec revenue, it is approximately $14 to $15 million per quarter, and we have made significant improvements in terms of cost. We believe the greatest upside lies in medical business, which does benefit from scale. Glenn can provide more specifics about the cost structure. Glenn Ibbott replied, thanks, Miguel. We are in 4 cannabis-related businesses plus Bevo, and our operations span the globe, requiring us to follow complex legal regulations and incur shipping costs through SG&A. We're looking for continued efficiencies, and have plans to reduce costs by $5 million a quarter. We don't need to scale up SG&A as we add revenue, we can hold it steady and improve our metrics. CIBC World Markets analyst John Zamparo inquired, can you provide some insight into the market share gains you have achieved in the edibles segment, particularly for chewable extract products? How do you see this trend playing out with regulators? Miguel Martin replied, John, thank you for your question. We are disappointed by Health Canada's decision to limit the potency of our glitched product to 10 milligrams in one package. However, we've pivoted in a timely fashion and launched other innovative products such as infused pre-rolls and minor cannabinoid gummies which have had great success. We're also focusing on sustainable and profitable market share, rather than chasing unprofitable market share. Going forward, we remain confident that the 10 mg cap will be addressed. Canaccord Genuity analyst Yoon Kang inquired, "Can you speak to the drivers of the sequential growth and adjusted gross margins for the wholesale bulk cannabis and Bevo Farms businesses this quarter?" Glenn Ibbott replied, "In our plant propagation business, we saw fully utilized facilities in Q3 and Q1, leading to higher margins. We expect these to be a bit lower through the remainder of the year. The orchid business launching at Sky is helping to smooth out seasonal effects. Additionally, bulk sale cannabis are giving us an outlet to sell higher potency volume that infuses nice margins into our core bulk sales." Miguel Martin replied, "We are delighted with this quarter's outcome and our continued prospects. We thank you for your interest in Aurora and look forward to providing further updates as we progress. Thank you."